Hey, welcome back to the channel. Today we're going to be checking out Alexandria Real Estate, ticker symbol ARE. They are a REIT that focuses on the life sciences kind of specialty in real estate. So, going to the 5-year chart, we can see the two previous lows that we've had over the last 5 years have been right about 110, and we're floating at about 119 right now. So, along with a lot of other REITs, Alexandria has sold off a pretty decent amount over the last, year and a half. So it looks like it could be getting interesting from an evaluation standpoint. So with that being said, let's go ahead and jump over into their website and investor presentation. All right, and here we have their website with a little bit of a geographical breakdown of kind of their real estate exposure in different areas. So we have Seattle, San Francisco, San Diego, Greater Boston, New York City, Maryland, and Research Triangles. If we go into some of these kind of specific areas, you can see Greater Boston has 14.2 million square feet. San Francisco is about 8.8. New York City, we got 1.3. San Diego, we got 8.1. Seattle, let's see, 3.3, Maryland 4.1, Research Triangle 4.0. So we have a pretty nice split between the East Coast and the West Coast as far as square footage wise. And we can kind of see that they essentially like to do these clusters around a lot of colleges, universities, research centers, and really cater into kind of what the life sciences industry needs for their space. All right, and then here we have the investor presentation for their recent 2023 Q1. So let's breeze through it and see if we can find anything interesting. So here they got a slide showing their historical returns from 1997 to 2023. So if you would have invested them back in 1997, you would have beat everything, essentially. So yeah, probably just a little plug for their previous performance, but that does not mean much for future performance. So, all right, so here we have a slide going over kind of liquidity. Looks like a little bit of percentage for fixed rate debt versus variable rates. You will see weighted average interest rate 3.73, really good. Remaining debt terms 13.4. Looking at their debt stack, I don't believe they have anything super immediate coming due, but we get a further breakdown of kind of their property types over their portfolio. So, yeah, 18% multinational pharmaceutical, 22 life science, 10% public biotech. So, kind of just a breakdown of the diversification of across the type of life science institutions that are leasing out space from them. And hey, look, tenant collections, almost 100%. So, yay. And then this almost looks like an explanation slide about basically why their leasing was only 1.2 million over this last quarter, kind of saying, hey, it goes back to basically the historical average. So I'm wondering if some investors may have been a little let down by that. All right, and then we have another graph for, let's see, historical rental rate increases. So, and then a slide pitching their dividends and their dividend growth over time. So 3.9% dividend yield. Right now, I think it's closer to about 4%. And let's see, 5.4% annual dividend growth per share average. All right, then we have more pitching, more pitching, more pitching. Looks like that's about it. It looks like it gets into financials after that. So, but we'll go over financials here in a little bit. So, with that being said, let us go and jump into the historical financials. All right, pulled them up here on our spreadsheet, evaluation sheet. Let's go over to the REIT metrics and we can kind of see historically what they've been doing. You see kind of, solid EBIT, net income, and operating cash flow growth. And always, as always, you kind of stick with operating cash flow since this is a REIT. Look at operating cash flow, dividends paid, and net income here. So they're paying out a decent amount towards dividends, but it's not anything crazy compared to their net income or their operating cash flow. So probably about 60%. We can see their operating cash flow per share growth over the last decade, along with their dividend to operating cash flow ratio. So we've seen at least pretty decent accretive investment on a per share basis as they've been diluting over the last 10 years. And we can see that the current payout ratio for the dividend compared to operating cash flow is about 58.54%, which is pretty healthy. Here we got interest expenses, depreciation, amortization, operating income, and gross profit over the last decade. So, up and to the right, that's good. Nice solid dividend growth over the last 10 years. See a lot of debt repayment over the last couple years, which was really good. They delevered a lot over the last like 3-4 years, and they put themselves in a really good position going forward as we got into like a higher rate environment. So operating cash flow and total compared to total debt, and then we have operating cash flow compared to interest, and you can kind of see how their operating cash flow grew substantially while their interest expenses have actually dropped off pretty decently over the last couple of years. And that gets us into the cash flow coverage ratio and the interest expense ratio. Cash flow coverage ratio is pretty dang good. They're sitting about 12.7 right now %. So their operating cash flow to their total debt is about 12.7%, and their interest expense ratio to operating cash flow is only 7.28. So that's pretty dang amazing. That's really good. So you get basically only 8% interest expenses compared to their operating cash flow. So really solid there. Let's go over to the REIT evaluation template, and we'll look at some more historical data. So we can kind of see the bottom line yields over the last decade and how the market has priced this. We kind of have this range of operating cash flow yield going up to about 7.22%. At the bottom is about 3.08%. And let's see, we're at about 7% right now. So we're kind of hitting that upper end of the operating cash flow yield compared to like the historical like 10 years. So it's starting to, it looks pretty interesting from the valuation standpoint, but maybe there is a reason for that. So nice dilution over the last 10 years as they have raised capital to fund projects. But the thing that we really care about is this per share growth right here, right, of operating cash flow, which has been pretty good, pretty accretive. So the debt that they have raised and the shares that they have issued have been accretive on a per share basis over the last 10 years. That being said, well, we got margins too. So gross margins, pretty strong. Right now we're looking at about 69% gross margins and 52% operating cash flow margins. Let's see, net margins or operating margins 26, net margins 27.2. With that being said, let's go ahead and jump into the evaluation. All right, so getting into the valuation here, I've got a 12.5% total target rate for the KGAR. It's about 10%, and then 2.5% margin of safety, and then we also have a 4% dividend yield on top of that. So really, this total target is more around like 16.5% target KGAR. We're doing a operating cash flow only analysis, so we're just going off of the historical information for operating cash flow and the basically the multiple that the market has given them in the past. We can see operating cash flow has grown at about 17.8% over the last 5 years. So, and that's with them diluting at about 10% per year. So you're getting like a net increase of about 7% per share per year. On the growth side, so for the 10-year treasury fixed rate, we have 2% to about 5%. Dilution, best case, we have 8.5%. Worst case, we have 12.5%. Bottom line growth, which is really just going to be the operating cash flow growth, basically 20% to 13%. Now, this would be like a really, really bearish scenario. I don't really, man, it'd be hard to see that happening because even if they didn't do anything, they could probably increase their rates, their rental rates at like 3% a year, or you need to do more kind of digging to see if there's any escalations already set in stone for the current leases. They might already have inflation escalation clauses and things like that. So that would be something to dig into to kind of fine tune these numbers. But for now, we got operating cash flow growth of 20% in the best case, 13.5% in the worst case. And then we're going just off of operating cash flow yield spread. Best case 1.52, worst case 5.06. So, and what I did with that, the reason I did that is that this kind of gives us the range that we saw previously in the multiples over the last 10 years. So, best case scenario, be 3.52% operating cash flow yield, and worst case scenario 8.04% operating cash flow yield. So that kind of gives us this range, going down to about 3.5 and up to even a little bit higher to 8% or so. The interesting thing that I've seen with a lot of REITs lately is everybody's talking about life sciences like a lot. So it kind of makes me wonder if we're going to see a lot of like overdevelopment in the life sciences space over the next maybe 5 years or so. And it might get to the point where there's a lot more pricing pressure from increased competition from other developers and other REITs, and they saturate the market and it's not as good over the next 5-10 years. I don't know. We'll see. I've heard it a lot on various, usually like multi-use REITs and office REITs, multi-development REITs. So that's something to be a little bit concerned about, that I'm a little bit concerned about at least. So getting into the kind of valuation here, with that 16.5% target KGAR, we can see kind of our fair value area is probably between, I don't know, 72 to 133 right now, somewhere in that spread right here. You can see that the current buy price targets for the very bearish is $62.90. Bearish is $86.62. Base case is 119.34. Bullish is 164.63. Very bullish is 227. So we're starting to get into that bearish case and that base case range. We're basically in the base case range right now. Yield multiple of 5.27 with bottom line growth of 16.7, which they've done previously. Dilution rate about 10.37, which is probably, they've basically averaged out over the last 5 years. So we'd have to kind of do a lot more digging to see what their development pipeline looks like, and forecast out how much dilution they're going to have and how much operating cash flow growth per share they're going to have based off of that dilution. But based off of just historical numbers, that's kind of where we're sitting. We're kind of sitting right at that base case. So the 5-year targets for this guy in the very bearish scenario is going to be 110. Bearish scenario is going to be 151. Your base case is going to be 208. Your bullish case is going to be 288, and your very bullish case is going to be 398. So, but this does not take into account all those dividends that you're receiving. So if you're getting in and you're getting a 4% dividend yield, and then that dividend is growing, you're going to be getting that 4% dividend every year, and this is just going to be the equity price at the end, or the estimated equity price at the end of the 5-year period, depending on what case they land into. So yeah, that's Alexandria. I have done a decent amount of looking into it, so it's something I am pretty interested in, and something I am going to keep an eye out on, and probably do a lot more digging into the life sciences space. The only thing that cautions me really right now is just, it seems to be like this is where a lot of REITs are kind of going. It seems like they're pushing more capital into life sciences, and that might be setting us up for an imbalance of supply and demand in the future, depending on how much build out we get versus how much demand is actually going to be there. So hope you guys enjoyed this. Have a great week, and we'll catch you later.